Welcome to Drama-Free Bitcoin, where we give you a calm and relaxing take on the Bitcoin markets. Today we're going to look at the company strategy and specifically their preferred stock called Stretch, ticker symbol STRC. So if you haven't heard of Stretch yet, I'll give you a quick overview today. So basically it's a perpetual preferred stock that has a $100 par, and with it comes a annual dividend of 12% currently. This is a variable dividend, so it can go up and down. Recently, it was raised, it started, I think, at 9%, and it's been raised every month since, and has recently raised a 0.5% to 12%. There's a high likelihood it'll get raised again here on August 1st, 2026 to 12.5% or 12.25%. So what this stock does basically is it lets strategy borrow from the public, pay them a 12% dividend or whatever the current rate is forever, and use that money to purchase Bitcoin. And the reason they're doing this is because they think Bitcoin will have a 29% annual return. Right now it's higher than that. So between now and 2040, I believe Michael Saylor said they expect Bitcoin to have a 29% annual return. So what they're doing is they have a long time preference here, right? So they're trying to strip the volatility off of Bitcoin and sell it to the public with something that has 1 to 5% volatility, which this instrument currently does not. Over time, it may become less and less volatile. So currently the price is below par. We had a big sell off recently, which I'll talk about in another video, but the current price is 85.13, which gives an effective yield for new people purchasing it of 14.1% currently. And if it does return to that $100 par, then that would be a 15% capital gain. The other interesting thing about Stretch is it actually functions differently from a tax perspective. It's a return of capital. So for the first 9 to 10 years, you're getting a return of capital. And then when you sell it, you have a long-term capital gain as well. So instead of getting dividends that are basically ordinary income, you get much better tax treatment with that. So strategy sees this as their iPhone moment in their mind, like this amazing thing. Everyone wants a money market fund that basically pays them something that beats inflation, really. And this does it, but unfortunately it's way too volatile for most people to handle right now. With that said, other things about Stretch is there are some downsides. So one is they can actually call it back and say, hey, we're going to stop paying you. In order to do that, they have to pay you $101. If they decide to stop and register your shares at some point, then you at least get your original investment back plus 1% plus all the dividends that you've received. The other thing is I don't think that they're required to keep the interest rates high. I don't know if there's anything that prevents them from even lowering the interest rate to 0 or to like 1% or something, other than just bad form. I think that the only reason they would do that is if they just abandon this product, but that would make the price go to 0 basically if they stop paying any yield on it. I'm not sure if they're allowed to do that. So if anyone knows, please put that in the comments below. This is the second highest on their stack as far as first in line if the company was liquidated. So it's basically Strife, STRF is first, and Stretch. And if we look at Strife real quick, we see that its effective rate is 10.26 and its yield is 10%. So it's pretty close to par right now, whereas Stretch is way down because of the recent sell-off. Another interesting thing about Stretch is it has variable interest rates. So let's say the Fed raises interest rates. This will probably have to go up as well because people will demand a higher yield in alignment with the risk that they're taking with this. So if the Federal Reserve lowers interest rates, though, then this potentially could start going down. Also, over time, as more people trust this and there's less perceived risk, it will go down slowly over time as well. So you can't say, okay, I'm going to lock in a 12% yield forever if they pay less. The other big change is they recently went from once a month dividends to twice a month dividends. And this is really great because it keeps from having to wait for like a whole month and have a bunch of people buy in just to get the dividend and then sell out, which makes the price kind of go all over the place. So it's a bit more stable with the twice a month dividends. So I think that was a good choice. Currently, historic volatility is 21.7, applied volatility is 26, 30-day volatility is 52%, which is insane, right? which is weird for something where they just basically promise to pay you forever. The other downside is it can't go really over 100 because they're going to sell more shares if it ever goes over $1.01 even. They're using a thing called at the market ATM, and they're selling more shares. So this dilutes you and pushes the price back down to 100. Then their hopes is if they keep raising the dividend yield, that will create demand for the product to push it back towards 100. And so then they're pretty much willing to borrow as much as they can. So it's in their interest to get this back to $100 par. They've made a bunch of structural moves, which I'll talk about in another video, to help do that. And the market has kind of stabilized around this 13 to 14% yield. One of the reasons that they've done that, I think, is because there's a competing product called from the company Strive. That's SATA. And they have a 13% yield doing the same strategy, basically borrow from the public with a perpetual stock and buy Bitcoin. But they have a much smaller balance sheet, and they also have no debt on their balance sheet. So in some ways, people see them as less risk, but they're so small compared to Strategy. And Strategy has this massive Bitcoin balance sheet of currently $50 billion worth of Bitcoin, 843,775. So huge amount of backing for this dividend. So anyways, the fact that SETA pays 13% and this pays 12%, and the market seems to be demanding over 14% for these instruments right now, makes me think that the dividend has to go up a bit more still. There's probably some limit to how high they'll raise it. We'll see what they do at the end of July, but I do think they'll raise it another half point at least to close that gap a bit, and that should bring the price up into the 90s. And then hopefully when the Bitcoin bull market kicks off, it'll get back up to 100. All right, that's just a quick review of Strategy's product Stretch. And just a reminder, this channel is entertainment and education, not financial advice. Make sure to take responsibility for your own choices. And if you have any comments on this, drop them in the comments below, and stay calm out there.